Everyone loves to ask the same question after a disaster. Did anyone see it coming? We imagine sudden collapse, a normal day interrupted by chaos. But the truth about the 1929 stock market crash is far more unsettling. It wasn't a lightning bolt from a clear sky. It was a slow-motion wreck that played out in full view, with warning lights flashing and sirens blaring. Only nobody wanted to hear them. An entire country convinced itself that the rules of reality had changed, that prices only moved one way. This isn't just a story about the past. It's a manual for how bubbles always end. To understand October 1929, you have to start in the glow of the 1920s. The First World War had devastated Europe, but the United States emerged with factories running, fields producing, and cities buzzing. New technology wasn't just exciting, it was profitable. Cars rolled off assembly lines, radios entered living rooms, and electrical appliances promised easier lives. Wages rose for many, and consumer credit helped people buy things their parents never dreamed of owning. It felt like the future had finally arrived, and it would only improve from here. The stock market became the scoreboard of this optimism. Newspapers splashed front-page stories about rising share prices. Business leaders gave speeches about a new era of permanent prosperity. For the first time, ordinary people, not just bankers and industrialists, began to see the market as their personal elevator to wealth. And here's the crucial part. Much of this optimism was rooted in genuine progress. Real companies made real products. Real profits existed. That's what made the illusion so dangerous. Because once people mix real growth with fantasy-level expectations, they stop asking hard questions. The line between justified enthusiasm and reckless dreaming quietly disappears. In 1920, stock ownership was still largely the domain of the wealthy. By the end of the decade, millions of shopkeepers, clerks, factory workers, and office secretaries had become self-styled investors. At least, that's what they thought they were. In reality, they were speculators, often without realizing it. The engine behind this transformation was margin. You no longer needed to have the full price of a stock to buy it. You could put down a small fraction, sometimes as little as 10%, and borrow the rest from your broker. With $1,000, you could control $10,000 worth of shares. As long as prices climbed, this leverage felt like genius. A small move upward could double someone's money. People told stories of neighbors who paid off homes, bought cars, or opened businesses thanks to stock profits. Those stories spread faster than any cautionary tale. Almost no one dug into balance sheets or long-term prospects. The conversation wasn't about companies. It was about tickers, symbols, not businesses. Lines on charts, not factories, inventories, or customers. This wasn't thoughtful investing. It was a nationwide casino dressed up in the language of finance. And the chips people were pushing onto the table weren't just spare savings. They were their futures. Every bubble has a moment when the story stops being, "This is exciting," and turns into, "This can't possibly go wrong." The late 1920s were that moment. Stock prices had tripled over the decade. In many cases, the income you earned from owning a stock was lower than what you could get from a simple bank deposit. Logic said, why take risk for less reward? But logic wasn't invited to the party anymore. Economists who warned about overvaluation were labeled pessimists. Advisors who suggested taking some profits were fired for being behind the times. Clients marched their accounts to more aggressive firms, promising bigger gains faster. The message was clear. If you weren't all in, you were missing out. This is the most dangerous phase of any mania. Doubt becomes socially unacceptable. Questioning the narrative feels like insulting your neighbors, your boss, your friends. People who sense something is wrong stay quiet because speaking up means being mocked or losing business. So the collective conversation narrows. Only one idea is allowed to live. Everything will be fine. That's when risk stops being measured and starts being ignored. And when risk is ignored, it doesn't disappear. It accumulates silently until it explodes. Behind the roaring market was a critical decision maker, the central bank. Interest rates set the price of money, and in the late 1920s, money stayed cheap. Credit was easy, loans were plentiful, and the cost of borrowing stayed low enough to keep speculation roaring. Policymakers faced an impossible dilemma. If they raised rates sharply, they might have cooled the markets, but they also risked slowing the broader economy, hurting businesses and employment. If they kept rates low, they knew speculation would worsen. Confront pain early or risk catastrophe later. They chose later. Investors took that as a blessing. Brokers extended more margin. Banks enabled more credit. Companies floated new stock issues into a market eager to absorb anything. The market didn't just feed on optimism, it fed on available credit. Every borrowed dollar used to buy stocks pushed prices higher. Rising prices justified even more borrowing. The loop fed itself. From the outside, it looked like prosperity. Inside, it was a delicate structure dependent on everything staying perfect. Low rates, endless confidence, rising prices. A system that can't handle disappointment is not strong. It's brittle. And by 1929, brittleness was baked into the foundation of American finance. Big disasters rarely arrive without a hint. The market in 1929 began to wobble before it collapsed. Late summer brought sudden drops, followed by sharp recoveries. A big down day would shake prices, then a burst of buying would prove the system was fine. Commentators dismissed these dips as healthy corrections. Investors even began to see them as opportunities, a chance to buy more at a small discount before the next leg up. This is a classic trap. Each successful rebound didn't reduce risk, it hid it. People took the wrong lesson. See, even when things get rough, the market bounces back. They stopped seeing volatility as a warning and started seeing it as reassurance. That false comfort is what makes the final shock so devastating. In the background, real-world data began to sour. Car sales slowed. Certain factories reduced shifts. Layoffs quietly increased in some sectors. The real economy was clearing its throat, but the stock market seemed uninterested in listening. Two realities began to diverge. One grounded in production and employment, the other built entirely on rising prices. When those two worlds get too far apart, history shows they don't drift gently back together, they snap. Many people still imagine the stock market as a separate arena, like a casino in its own building. In 1929, that illusion was deadly. Banks didn't just lend to businesses and homeowners. They also held stocks, often in large quantities. Their balance sheets depended on the value of those holdings. When share prices looked strong, banks looked healthy. When prices dropped too far, those same banks suddenly looked fragile. Businesses depended on those banks for credit. They used loans to buy inventory, pay workers, expand factories, and bridge slow periods. Households relied on banks for mortgages and small business financing. So when stock prices fell, it wasn't just shareholder wealth evaporating, it was the support structure of the entire economy weakening. If banks took heavy losses, they might stop lending or call in loans early. If loans were called in, companies couldn't operate smoothly. If companies couldn't operate, jobs disappeared. Savings were another weak point. There was no broad safety net. If a bank failed, deposits could vanish with it. That meant a market crash wasn't just a Wall Street problem. It threatened living rooms, kitchen tables, and dinner plates. The system was tightly wired together. Once one section blew, the shock traveled everywhere. October 1929 did not begin with fireworks. It started with unease. As the month rolled on, selling picked up. A few down days turned into a trend. Then came Thursday, October 24th, later known as Black Thursday. Panic erupted. Sell orders flooded brokerage offices. Ticker machines fell minutes and then hours behind real-time trading. People had no idea what their shares were worth in the moment. They just knew they wanted out. Temporary interventions by powerful bankers briefly slowed the stampede. Headlines tried to reassure the public. Over the weekend, newspapers insisted that the worst was over. Many clung to that hope. They needed to believe it. Monday destroyed it. On October 28th, selling resumed with ferocity. Prices didn't simply slip, they plunged. Billions in paper wealth evaporated in hours. Crowd scenes near the exchanges captured the shock on people's faces, though the real devastation unfolded quietly, in homes, when families realized their margins were wiped out and their debts remained. The market's beauty during the boom, speed, access, leverage, became its weapon in the bust. There was no break, no pause, no kindness. Once confidence broke, prices chased it downward with the same intensity they had once followed optimism upward. The headlines focused on the stock index, but the real story happened in slow motion after the big drops. Brokerage houses that had happily extended margin during the boom suddenly faced mountains of unpaid debt. Many collapsed under the strain. Banks that had lent to those brokers and speculators absorbed huge losses. Some could not survive. When banks failed, depositors lost their savings overnight. There was no universal insurance scheme to make them whole. Credit, once abundant, began to dry up. Businesses that had depended on loans to operate found doors closing. Expansion plans were shelved. Then payrolls were cut. Factories that had worked around the clock reduced shifts, then shut down altogether. Unemployment climbed. Families who had believed themselves safe and middle class suddenly faced eviction, hunger, and uncertainty. It wasn't just numbers on a chart anymore. It was soup lines, boarded up storefronts, and homes emptied of furniture sold to cover debts. The crash exposed a brutal reality. A system built on borrowed money and blind faith can fall much faster than it rises. The wealth that felt solid in October existed largely in inflated prices and fragile institutions. When those vanished, what remained were the things that had always been real: land, skills, resilience, and for too many, hardship. One of the most disturbing lessons of 1929 is that it wasn't a mystery to everyone. There were analysts, bankers, and economists who knew things were out of line. They saw valuations that made no sense, debt levels that couldn't be justified, and a public piling into markets with little understanding of the risks. Some spoke out, some wrote op-eds, some quietly reduced their exposure. But structurally, the incentives were stacked against caution. Brokers made money on trades, not on restraint. Promoters made money selling the dream, not questioning it. Politicians preferred headlines about prosperity, not warnings about excess. Ordinary investors didn't want to hear that they might lose everything. They wanted to hear that they were smart, early, and destined to be wealthy. So warnings became background noise. This isn't unique to 1929. It's how most financial disasters develop. There is almost always someone sounding the alarm. The problem isn't the absence of signal. It's the unwillingness to act on it. The more people benefit from a bubble, the more emotionally and financially costly it becomes to admit it's a bubble at all. By the time reality forces its way into the conversation, it's rarely gentle. It kicks the door in. Stripped of all drama, the crash of 1929 came down to a simple imbalance. Belief outran reality. Stock prices no longer reflected what companies earned, produced, or owned. They reflected how excited people felt. The more prices rose, the more people believed they should rise. That self-reinforcing loop worked beautifully, until it didn't. Systems are most fragile when their stability depends on everyone continuing to believe something that isn't quite true. In the late 1920s, millions believed you could borrow heavily, buy endlessly, and somehow avoid paying a long-term price. When enough people finally realized this story was false, the reversal was violent. The Great Depression that followed wasn't just a bad year or two. It dragged on for over a decade. Jobs disappeared, industries shrank, and the idea of automatic progress died. It took a global war and a complete reorientation of production to rebuild the economy. The people who suffered most weren't stupid or greedy caricatures. They were ordinary families who trusted the loudest voices and the easiest narrative, that risk had been conquered. The people who fared best were those who anchored their decisions in reality, owning tangible assets, avoiding extreme leverage, and questioning the crowd when the crowd stopped questioning itself. The 1929 crash isn't just an old photograph in a history book. It's a recurring pattern in human behavior, played out with different technology, different assets, and different headlines, but driven by the same emotions: greed, fear, and denial. Whenever you see a market where everyone believes prices must keep rising, whenever people start borrowing heavily to chase past returns, whenever skeptics are mocked and caution is treated like weakness, you're not just watching numbers, you're watching the early chapters of a familiar story. You don't have to predict exact dates. You don't need to call the top. But you do need to recognize the warning signs of a system that's drifting away from reality. That means asking harder questions when everyone else is relaxing. It means respecting risk even when you're winning. It means building a financial life that doesn't collapse just because sentiment flips. If this breakdown changed how you think about market stability, don't let it be a one-time wake-up call you forget tomorrow. Hit subscribe, stay with this channel, and let's keep unpacking the hidden patterns behind headlines, booms, and crashes, so you're not merely a spectator in the next cycle, but someone who understands it well enough to navigate it. Because history doesn't have to repeat it in your life if you're willing to learn from it now.